wake up at your desk staring at multiple charts and price tickers flashing rapidly across your screen. Each green candle feels like hope. Each red one feels like a warning. You've read dozens of strategies, watched countless tutorials, and memorized technical patterns that are supposed to give you an edge. And yet, despite all that preparation, your account balance feels fragile, your confidence fluctuates, and one small mistake can erase hours of progress. This is the reality that most beginner day traders face. The allure of strategy can overshadow the silent, far more critical element of trading success: risk management. At first glance, it's natural to focus on patterns, indicators, and entry signals. After all, these are tangible rules you can study and practice. Candlestick formations, moving averages, Fibonacci retracements, they all promise a logical framework for predicting market movements. Yet, no strategy can fully account for the randomness, volatility, and emotional swings of the market. A technically perfect setup can still fail simply because the unexpected happens. A news headline drops or liquidity dries up. The psychological trap here is subtle but powerful. Beginners often conflate strategy with control. They believe that if they can master enough charts, memorize enough indicators, and follow the perfect setup, profits will naturally follow. This mindset creates a false sense of security, leading traders to take larger positions than they should, ignore stop losses, or enter trades without considering what they could actually afford to lose. The focus shifts from surviving the market to winning the setup, which is the exact opposite of what sustainable trading requires. Risk management, in contrast, is the discipline of protecting your capital before you even think about profit. It is a quiet, almost invisible framework that works even when strategies fail. Simple rules like determining position size, setting stop-loss limits, and understanding your own psychological thresholds are far more predictive of long-term success than any chart pattern. These controls create a margin of safety that allows you to stay in the game, learn from mistakes, and avoid catastrophic losses. Mathematically, this can be seen clearly. Imagine two traders with identical strategies. Trader A uses strict risk management and only risks 1% of their capital per trade, while Trader B ignores risk limits and sometimes risks 10% per trade. A string of 10 losses at 1% reduces Trader A's capital by only 10%, leaving room for recovery. The same streak for Trader B reduces capital by nearly 65%, making it extremely difficult to recover even if the strategy is fundamentally sound. Risk management doesn't guarantee profits, but it determines whether you can continue trading long enough for any strategy to matter. Behaviorally, risk management also shapes emotions. Knowing that each trade has a defined maximum loss reduces anxiety, prevents impulsive reactions, and helps maintain a consistent decision-making process. Traders who lack these boundaries often experience heightened stress during every trade, causing hesitation, overtrading, or abandoning strategies prematurely. Markets are volatile, and without psychological safeguards, even small losses can spiral into panic-induced mistakes that compound rapidly. When we zoom out, the lesson extends beyond individual trades. Markets are inherently uncertain and often behave counterintuitively. Economic reports, sudden political events, or unexpected market moves can invalidate even the most robust strategies. A trader who prioritizes risk management treats each position as part of a broader system. The goal is not to predict every price movement, but to ensure that no single loss threatens the ability to trade tomorrow. This systems level perspective transforms trading from a high stakes guessing game into a disciplined practice where survival is the first prerequisite for learning and growth. The identity shift here is subtle but profound. Instead of seeing yourself as someone chasing the perfect setup, you begin to think like a steward of capital. Your success is no longer measured solely by individual wins or losses, but by your ability to navigate uncertainty while preserving resources. You learn to accept that losses are inevitable, but catastrophic losses are optional. Risk management becomes your compass, strategy becomes your tool, and patience becomes the bridge connecting the two. Closing calmly, it is important to recognize that no indicator, chart, or pattern can replace the discipline of risk management. Beginners who obsess over strategy without understanding exposure are vulnerable to the unpredictable nature of the market. By contrast, those who prioritize protecting capital, limiting losses, and managing emotional responses position themselves to survive, adapt, and learn over time. In trading, survival is the foundation upon which strategy can actually generate consistent outcomes, and this principle remains true regardless of market conditions or technological tools. Understanding this distinction between the allure of strategy and the quiet power of risk management is the single most important lesson for any beginner trader. Strategy is seductive, immediate, and tangible. Risk management is subtle, slow building, and invisible until it is too late to ignore. Those who internalize this lesson early do not promise themselves instant profits, but they do give themselves the only thing truly necessary to become capable traders: the ability to stay in the game day after day, trade after trade, learning, adjusting, and surviving in the unpredictable world of financial markets.